Welcome to this week's Market Update, where we review the key developments that shape markets, highlight what drove our performance, and look ahead to the important events on the horizon. Let's start with what moved markets this past week. The big story was a powerful vote of confidence in artificial intelligence leadership, as one of the world's largest technology companies made a major commitment to the chip maker at the center of the AI revolution. Meta's decision to invest billions in Nvidia's AI chips sent a very clear message. Nvidia remains the go-to partner for building large-scale AI systems. Nvidia's stock had been lagging its peers as investors had been questioning whether competitors could challenge its dominance. Meta's commitment challenges that thesis by choosing Nvidia's full product suite, including processors, networking, and related technology. Meta is signaling that Nvidia offers the best value for AI at scale. For our portfolios, this reinforces why we own leading AI platform companies rather than chasing more speculative plays. The United States ended 2025 with one of its largest trade deficits on record, at just over $900 billion. While that sounds concerning on the surface, much of the increase was actually driven by importing advanced technology equipment to power their AI initiatives. American businesses are actively investing in the future. While the trade gap with China narrowed, more goods are flowing through Mexico and Vietnam. For investors, this highlights the continued strength in technology infrastructure spending, which directly benefits the companies that we own in our portfolios. On inflation, consumer prices rose at a slower pace in January, with the headline inflation dropping to 2.4% from 2.7% in December. That is better than expected. However, while gasoline prices fell, the cost families feel most, including food, electricity, natural gas, and insurance, still remain elevated. Some pressures reflect tariffs, while others stem from energy demand driven by AI data centers. This mixed picture is unlikely to push the Fed to change their course on rates and does support owning companies that can pass along cost to their customers. Now let's look at what drove our performance over the past week. Deere was our standout performer with an impressive 11% gain. Growing confidence in global economic stabilization, combined with infrastructure spending, create a very favorable backdrop for this industrial leader. Deere has invested heavily in precision agriculture, using GPS guidance, sensors, and data analytics to help farmers produce more with less. Revenue continues growing and cost management remains very disciplined. This is exactly the type of company we seek. A market leader with pricing power, innovation, and financial strength. The industrial sector led our performance with broad-based gains. Deere led the way. Lockheed Martin also rose 4.5% on strong defense spending, and Vertiv Holdings gained nearly 3% as data center construction does continue to accelerate. Automatic data processing, Canadian Pacific, Kansas City, and Honeywell all contributed to gains as well. The breadth is compelling, spanning defense, data infrastructure, transportation, and traditional equipment. Demand drivers are broad and not dependent on just one trend. Our industrial holdings share strong balance sheets, pricing power, and exposure to durable demand from infrastructure and defense budgets. Our momentum strategy delivered the week's best results with a 2.7% gain. Applied Materials surged over 12% on semiconductor equipment demand. Palantir rose 4.5% as its AI analytics platform continues to win new contracts. ARM Holdings gained nearly 4% at the heart of chip design. Morgan Stanley also added nearly 4% on renewed capital markets confidence. This diversity, from chips to financial services, tells us that the market is rewarding strong execution across many industries. Looking ahead, here are the key events that we're monitoring. Tuesday will bring the Consumer Confidence Index. Back in January, this index plunged nearly 10 points to 84.5. That was the lowest level since 2014, driven by frustration with higher prices and uncertainty around tariffs and job security. Next Tuesday will show whether this pessimism is deepening or stabilizing. Consumer spending drives 70% of the economy. So our portfolios focus on companies that have strong brands that hold up when consumers get a little bit more selective. Next Thursday, we'll also bring the latest weekly jobless claims. Last week's data was slightly encouraging and a bit of a reprieve from recent upticks. This highlights that the recent trend has been consistent. Low firing rates offsetting soft hiring, which is exactly how the Fed has described it. We'll be watching Thursday's report for any shifts, as a stable labor market without overheating remains the ideal backdrop for the companies that we own in our portfolios. Friday brings the Producer Price Index, measuring what businesses pay for goods before they reach consumers. December showed wholesale prices rising by 0.5%. That was well above expectations, with core prices surging 0.7%, that being the biggest jump since July. Headline producer inflation held steady at 3%, while core accelerated to 3.3%. Rising business costs can flow through to consumer prices, reinforcing why we own companies with pricing power to manage the higher input costs. As always, we remain focused on helping you achieve your long-term financial goals through disciplined investing and thoughtful portfolio management. Thank you for joining us, and we'll see you next week.